the best leverage that incumbent producers or developers have is time. And I think we've kind of seen Cameco do this over the last couple of years, where they have the ability to produce, they have the ability to supply utilities with material when they want it. It's just a function of, hey, are we getting the prices that we need? And Cameco has been very redundant and trying to drill this point home to, I think, all stakeholders in the industry and investors.
Hello, everyone, and welcome to another edition of Triangle Investor Interviews. I'm your host, Lucian Malkovic, and before I announce my guest, just a quick reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products, or services. Always do your due diligence and consult with your financial advisor. I am thrilled to announce my next guest, a renowned uranium market expert and founder of Golden Rock Research, Mr. Timothy Cilleri. Welcome to the show. It is great to have you, really.
It's really nice to be here, Lucian. It's a very exciting time in the market, of course. So there's a lot of things that we can discuss and cover. So happy to be here and share my thoughts with your viewers.
Thank you very much. I look forward to it. It is your first appearance in front of the camera to talk uranium, right?
Yeah, I mean, I've chatted with some folks, privately, and I've done one interview that was kind of behind a paywall for some folks. So this is the first one that's a bit more public that I've done, and excited to be here and chat the market with you.
Yes, that said, since this is your first, let's say, public interview, let's start with your origin story. Can you give me a little bit of your background and what are you doing today?
Yeah, so when I came out of university back right around the great financial crisis, I had a friend of mine whose father had been in financial markets and running his family's capital for a long time. And he kind of gave me the advice that I would need to kind of pick a road if I wanted to kind of head to Wall Street, which was going down equities or commodities. During this time frame, the China bull market in commodities was fully underway from the early 2004 period, kind of through my university experience. I thought commodities was interesting. Not a lot of people seem to go that way, so I decided to do it. I graduated right into the great financial crisis in 2008, so that was an interesting experience to kind of start my career, and landed in Chicago at the time as a futures and options broker. So I covered a lot of different commodities at that time for customers and traded on their behalf as a broker, not trading, but simply filling orders on their behalf. And it was a really interesting experience for a couple of years in terms of just the depth and width of different commodities and futures to kind of follow. So I did that for a couple of years, and then I got the opportunity to become a physical commodity trader for Olam International, which is really a very large physical trading house headquartered in Singapore. I worked in their North American offices and marketed a very niche commodity for them, cashew kernels actually, which was a really wild and interesting experience, and really kind of where I cut my teeth becoming a professional in commodities in terms of learning just about where commodities come from, origination of commodities, or origination rather, apologize there. All the way to the end markets and the supply chains that go into them, really building out primary supply and demand work, working with a couple other more experienced traders than I was at the time, really to cut my teeth kind of in that industry. And one of the things that I took away from that experience after several years was very few people follow that particular agricultural commodity. And what I realized was that there's a lot of different niche commodities out there where information was not widespread and that there was real information and behavioral edges. Around this time, I happened to be looking for kind of personal account ideas in bombed out commodities and stumbled into uranium in the summer of 2015. This is a time when spot prices were about $30 a pound, continuing to go lower to their cycle lows of about $18 about 2 years later. And during that time, doing research, ended up running into Mike Alkin, and we did some research together. He ultimately decided to start a fund, asked me if I wanted to join and help him, which I did, and ended up working at Sachem Cove for about 7 years, which was an absolutely tremendous experience. It was really exciting to kind of publicly call the coming bull market in uranium. I was able to work with Mike, who's an absolutely outstanding portfolio manager and analyst. Learned a tremendous amount from him. And so worked there for 7 years and have since started Golden Rock Research. Part of this was really fully understanding just how structural and long-term some of the issues on the supply side are, and realizing just how long of a runway that there is. So I'm here kind of doing research, commentary, analysis on the industry for folks that a little bit more focused towards equity investors and commodity investors. Of course, that's kind of the main clients that I have and customers that I have these days. But in kind of the quick and dirty, that's kind of my professional experience up until this point.
Yeah, and you are a great person to follow. You're one of my top, let's say, 5 guys to follow when it comes to uranium, and I urge people that they should follow your work. It is very, very impressive, as is your
Thank you.
background.
Thank you.
You've highlighted the structure. Let's go with the uranium topics, of course. You've highlighted the structural deficit in uranium supply and skepticism about new project timelines. That is something that I did as well. My question to you is, which specific projects do you see as the most likely to face delays, and what are the key bottlenecks? Permitting, financing, technical challenges, or something else?
Sure. On the permitting front, it really depends on the jurisdiction. I mean, we certainly see that permitting hurdles are overcome a bit faster in places and jurisdictions like Africa, Niger, and Namibia, for example, versus some of the Western countries. Um, I think at the end of the day, the elephant in the room is ultimately what's going to happen with NextGen's Rook 1 project, the Arrow deposit. Obviously, they've made a tremendous discovery in the southwest corner of the Athabasca Basin. They've grown that resource to a very impressive amount of, based on their life of mine resources. We're talking about, close to 250 million pounds or thereabouts in M&I. And I think at the end of the day, the industry and utilities need to take a view on this particular project. And that's simply because of the kind of the size of it and the potential duration that it could last in terms of being mined. And so I think at the end of the day, people really need to understand how big of a project it is, how much of an impact that it can have on the market, and ultimately form views around that. There are other projects. There's another very good project up in the basin being run by Denison Mines, their Wheeler River project, their Phoenix deposit. They're currently also going through permitting process right now. And we're finally, after years and years of following this market, we're getting to a point where we're finally going to get some answers from the Canadian regulators on both of those projects. They'll be having their final permitting hearings coming up very shortly. And so by kind of Q1 of 2026 into Q2 of 2026, I think the market will have a much greater understanding about what's going on with the permitting on those two particular projects, and how things will be able to be advanced from here. So, I'm keenly, just like everyone else, keenly following what is going on there, and what the resolution of the permitting hearings will be, as I think it will give utilities a much better sense of when those projects could come to market. Again, I'm not a geologist, I'm not a mining engineer, but visiting some of these projects around the world and being able to have the privilege to go up and visit MacArthur River a couple of years ago, you realize that just how spectacular these projects really are, and just the massive undertaking of capital, of time, of skilled labor it takes to put these into production and then continue to steadily produce year after year. So again, I think the market and utilities will have a much better understanding of what the timelines will be once we get through these final permitting hearings. Nonetheless, even if both of those projects are permitted and allowed to advance through the Canadian regulators, we're just going to need to see kind of how long it's going to take to ultimately get these projects developed. Denison is keen to try to get into production in about 2028. We're not sure if that means they'll get into production in 2028 and ramp to the full amount of their feasibility studies, or they'll be kind of a little bit less than what some of the feasibility studies call for right now. So we'll kind of see how that goes. And then on the Arrow front, I think we just really need to understand what the final answer will be out of Canadian regulators. And then once that happens, I think the next real hurdle will be just some of the financing. To be honest, given the turnaround in nuclear sentiment, I don't think it will be particularly difficult or impossible to get a project like Arrow financed based on what their needs are. There is a tremendous amount of interest in this industry, and I think capital and investors, whether it's debt or equity, really understand the growing need and role that nuclear is going to play, and that's very, very supportive of these projects. It's just a function of how much capital will they be able to secure and when, how much labor they'll be able to secure, and ultimately go through some of the technical drilling and things that they're going to need to do to get that mine open. So I can't sit here and give a date as to when that'll be. I mean, we really need to kind of cross the permitting bridge, but I think finally after several years, the market will have a little bit more clarity on that front.
Yes. Where do you see Triple R from Paladin in the equation? Do you see them producing in, let's say, 2031, 32, something like that? Or your...
I think that might be a touch aggressive. I think Paladin at the moment, which obviously owns the Triple R deposit, which they bought from Fission, they're certainly focused on Langer Heinrich at the moment and ramping up Langer Heinrich to its licensed capacity of, call it 5 to 6 million pounds a year. Obviously, they have their own internal team working on the Triple R deposit. With that said, it isn't exactly known how some of this will go, because obviously Triple R is, well, for viewers, it's very close to the Rook 1 project, Arrow's deposit. And so there's obviously been talk in the market about synergies, about milling and processing. Is there really a need to have two mills very close to each other in that part of the basin? So from my lens of the world, it isn't clear to me that that deposit would be able to come on in the 2030, 2031 timeframe. But they're also just kind of a little bit earlier than certainly Arrow and Denison right now in terms of permitting, in terms of feasibility studies, and kind of understanding how comfortable they are with the deposit and advancing it. So I think it's a bit early to understand how quickly Triple R could come online in that time frame. I think we probably just need to get some more information from Paladin in terms of what they're doing to advance, kind of understand how they might think about processing. Is there synergies potentially with another mill being there as well? So from my lens of the world, it's quite unclear that time frame would be possible right now.
That's a very good point. Before we move on, just one question. I'm returning to NextGen. Do you believe or do you see that NextGen will produce that uranium, or you think they will be acquired in the meantime?
That's a tremendous question. There's certainly been speculation for quite some time, for years, that NextGen and Arrow would be a prime takeout candidate, considering it is a generational deposit, not just within uranium, but within other minerals as well. I think ultimately one day it will get taken out. And that's just a function of bringing on the scale and scope of these deposits is not easy in any way, shape, or form. Again, this is coming from an amateur, mining engineer. I'm certainly not a professional in that regard. I don't build mines. I've never built mine, nor will I ever. I just think that given kind of the chessboard of players, if you will, and those with the experience who have built some of these underground mines in that jurisdiction, it probably makes sense for at least one company or a joint venture to potentially take out that project. I'm obviously talking about Cameco and potentially Orno, who work together on MacArthur River and Cigar Lake. So I do think they ultimately get taken out one day. I'm not sure how imminent that is per se. I think anyone who or potential suitors would want to see kind of how the permitting process goes for that particular deposit and understand kind of how they're thinking about advancing it. So
Yeah,
again, we'll see. I don't have a crystal ball on that front,
of course.
but I do ultimately think that they are taken out in some way, shape, or form.
Very good answer. Let's return to the big picture. China's projected uranium shortfall of 70 million pounds through 2030 is striking, to put it up mildly. How do you see China addressing this gap, and what impact might their strategies have on the global uranium prices and supply chains?
Yeah, but it's a great question. So the 70 million I come up with by taking a look at what the China produces domestically within their own borders, as well as any projects, ownership stakes that they have abroad, which is primarily in Kazakhstan and Namibia today. They also have a deposit in Niger, which they are not really doing anything with, at least at the moment. So when you compare their reactor consumption to domestic, as well as some of the other items I just mentioned, that supply deficit works out to be about 70 million pounds. Of course, they are sitting on very large inventories because they know that they don't have a tremendous amount of domestic capability to mine and grow uranium. They mine a couple to several million pounds a year. Today, they could, probably come close to doubling that on an annual production number, in the future. But again, you're talking about 8 to 10 million pounds of domestic production if they were able to grow it to that level. And this is a consumer of uranium that's going to be consuming probably somewhere between 70 and 80 million pounds a year by 2040. They consume somewhere about 30 million pounds today, and that's going straight up and to the right.
Yeah.
So, in terms of being able to secure that material, I think that we'll continue to see more of what we've seen over the last couple of years, and that is continue to take stakes in projects abroad. They've been very active in Kazakhstan with their JV partner Kazatomprom, of course, and I'm actually quite surprised that they haven't been more active in Africa. There are some well-known development projects in Namibia, for example, also in Niger. As well as, there are some other mines and deposits in Africa as well, but certainly Niger and Namibia have a lengthy history of uranium mining there and are very supportive of the industry. So I'm a bit surprised the Chinese haven't been more active in Africa. Even when you go and try to conservatively model their demand through 2040 or 2050, it's a tremendous amount of feedstock that they're going to need, and even including, let's say that their current inventory levels are, call it 500 million pounds a year. That seems like a big number. But again, when they're going to be consuming 70 to 80 million pounds a year by 2040, that stockpile shrinks significantly. So I think that they'll need to continue to be active in taking more ownership or stakes in projects outside of China. And it would be curious to see if they even go to places like South America. I mean, there are deposits in South America, for example. It's not, really largely talked about in the market, but at the end of the day, they're going to need to be finding projects and deposits anywhere they possibly can. And so I wouldn't be so shocked if they went into places like South America as well, outside of Africa, to continue to get as much mineral resource growth as they can find.
Yeah, you mentioned Niger, and when we are talking Niger, we cannot skip the topic of global atomic. I'm not sure if you are following that story, but I believe you are. You are. What's your take on how will global atomic resolve their financing? Obviously in Q4, and what do you see in the future for them? Do you see more hurdles, or you see a steady production? What's your take?
Well, I think, I'm very sympathetic towards the company because they've been quite unlucky,
Yes.
for sure. I mean, they have a very good high grade deposit in Niger. This is a mine that's capable of producing, 4 million pounds a year for quite some time, and
And
it
at low
just
cost.
been. Yes, at low cost, so it's been very unfortunate with the coup d'état that occurred in the summer of 2023. That it's obviously thrown the country for a big loop in terms of uranium mining. Obviously, we've seen the French basically be kicked out of the country. It kind of looks like there's currently some lawsuits going on as to how some of that will be resolved with the French. But coming back to Global Atomic, it's hard to know. I think ultimately based on the market cap, the enterprise value of the company today, it's very very cheap on paper. It's hard to understand how this will resolve itself in terms of the military junta. The government today in Niger appears supportive of the project as they continue to advance things. That seems to bode well for Global Atomic. It's just a function of how is the financing ultimately resolved. Is the company able to, ultimately issue all equity, which would be, certainly maybe not the best case for the company and its shareholders given the share price and market cap today, or would they be able to get some project financing, from the U.S. government or various places that could come from? So. I'm not sure how it's going to resolve itself. I mean, at the end of the day, it's a very real asset. It's a very good asset. It's just a function of how our property law is going to work in Niger. Is the government going to continue to be supportive of the company? And will they be able to get financing? I don't know the answers to that question,
Sure.
unfortunately. But if they are able to cross the line and get financed, if they're able to cross the line and get into production with a government that's supportive of that, I think that bodes very, very well for the future
Yeah.
of Global Atomic.
Yeah, Tim, let's discuss utilities and contracts. You've criticized utilities for their short-sighted approach to contracting and price resistance. What specific changes in utility behavior or contract structures would you advocate for better align with the market supply demand realities?
Sure. So, I think there's a couple things going on here. Number one is not all utilities are the same. I think I generally break up utilities into what I call kind of tier one, tier two, and
Hmm.
tier three. Tier one being kind of the most forward looking and strategic, who do probably the most due diligence on supply and demand, on the supply chains, on projects. And I think they've been relatively active. I mean, when you look at what the term volumes have been over the last 1 to 2 years, I think the bulk of it has been those kind of tier one utilities who recognize, hey, prices are increasing. When we look out at the landscape of incumbent producers, brownfield, greenfield, it probably makes sense to get some coverage out into these years to kind of, not hedge yourself per se, but just get price coverage on from producers or developers that really have the ability to come on. So I think they've been kind of playing it pretty well for the most part. Um, and with that said, you have to realize that utilities have faced issues outside of their control over the past 5 years. When we go back to February, March of 2020, of course, COVID hit, and this was very challenging for utilities. They needed to make sure that they had healthy employees and staff to run their reactors. I mean, this was a real 2 year problematic period for them, given what was going on in the world. So they were clearly not very focused on procuring things, rather, ensuring that their plants could run. So that's a 2 year period that chewed up. Well, when you get to February or March of 2022, of course, we get into Russia invading Ukraine, which has turned the fuel cycle upside down. In kind of round numbers, Russia's Rosatom controlled about nearly a quarter of global conversion capacities, as well as not quite a half, but almost half of global enrichment capacities. So when the West, and particularly U.S. utilities, said, "Hey, we're going to self-sanction from Russia effectively. We're not going to sign new contracts with them." And we're going to look elsewhere. Obviously, this had a tremendous impact on conversion and enrichment prices. They've gone up materially as there's real tightness for all that Western demand from those Western converters and Western enrichers, of course.
Yeah.
So that's really been their focus for the last couple of years. Now, of course, it's now been about 3.5 years since the Russian-Ukraine war started, and my sense is, given the volumes that we've seen in term conversion, in term enrichment, the Western utilities and the U.S. utilities have done a good job of putting on coverage through kind of the end of the decade. And my sense is they're turning their attention back to uranium now. And while it has been 5 years since COVID, over 5 years since COVID has happened, those were real issues for global utilities, particularly Western utilities. And I don't think that should be discounted. They had no control over a lot of that stuff. And so it does make sense that utilities behave the way that they have over the last couple of years in that regard. And then you couple this with the spot market making a very, very large run from the summer fall of 2023, from about $55 to, north of 100, about $107 spot peaked out at for a brief moment before kind of coming back. That made utilities nervous. And generally speaking, I think a lot of utilities, when there's a lot of volatility price-wise in the market, they say, we're just going to back up and kind of wait it out for a little bit and kind of let the dust settle. And because prices moved so quickly and so sharply from that kind of mid-50s level up to north of over $100, it brought a lot of inventory to the market, right? I mean, inventory and prices are a dynamic kind of relationship. When prices go up materially to 17-year highs, you're going to see inventories, you're going to see supplies sold back into the market because it's a very relevant time to sell things. A 100,000 pound lot that was normally $3 million when spot was $30, and then just a couple of years later, suddenly that's a $10 million ticket. You're going to get some sellers into the market. And so utilities, I think, made the right move there of kind of stepping back from the market and saying, we're going to let this kind of settle down and play out. We've retraced, of course, from those levels of 105, 107. We got back down into the low middle 60s per pound on a spot basis this year. And we've obviously risen back up into kind of the low 80s now. And, what we saw was at $100 spot, $105 spot, there was very little fundamental interest in the market. But when the prices moved back into the low middle 60s, we saw a lot of utilities come back to the market. We saw a lot more fundamental demand saying this is a good value area, we think, to add some coverage if we can pick off some pounds in the spot market, which we saw utilities do. So in that regard, it's a dynamic situation from that. But given where we are now, as I've written about, more recently over the last couple of months, is now that utilities have been able to secure a bit of conversion and enrichment in meaningful ways, probably through kind of the end of the decade, I think we'll see them turn their attention a bit more back to the uranium term market. And this is in conjunction with getting a lot of information about the two Canadian projects we talked about earlier. So I think it's kind of coalescing and coming together where utilities are back kind of in the driver's seat of saying, okay, it's time to turn the page on some of the conversion and enrichment. Let's take a look at what our needs are for uranium coming up. Oh, by the way, there's two Canadian projects we want to kind of have a better understanding of. We're going to be getting through those permitting hurdles. So I think the market is coming together in a way where we'll see term volumes accelerate from here over the past 1 to 2 years that we've seen.
Yeah, again, excellent point and analysis. Tim, market-related contracts with collars. There seem to be gaining really traction. How do you expect this shift to influence spot price volatility, and what challenges might arise in accurately reporting these hybrid contracts?
It's a good question. I don't think that the term market transitioning to more of a market-related contracts will structurally change the spot volatility regime. I think you could see, so the way that it works is, come month end, you get the price reporters reporting the base escalated price, and any market-related contracts will be priced off depending on who it's between, typically a certain date and time wherever that price is. So going into those windows when market-related contracts are being priced off of the spot market, you might get a little volatility where a supplier might say, hey, we really want to make sure we defend prices here to get the highest price that we can selling into those term contracts. You might get buyers trying to, knock the price down a little bit to save some money as well. But I don't think that structurally changes anything. That's just kind of noise in the market, but not a structural driver of anything.
Sure.
Um, in terms of the way it's being reported, yeah, I mean, we hear, we hear industry stalwarts like Cameco kind of, it certainly sounds like they're a bit frustrated with the way things are being reported. They certainly talk about publicly about looking to get market-related contracts with floors at around $70 a pound, ceilings 130, north of 130. And so they say, look, the midpoint of that's about $100. Versus base escalated prices being in the low 80s. They've recently come up vis-a-vis the September month end pricing. We've seen UX raise prices a couple bucks to 82, Trade Tech up to 84 for base escalated. But do I think price reporters could introduce something or at least have commentary around it a little bit more? Yeah. I mean, I think they probably could. I mean, at the end of the day, they can kind of do whatever they want. I mean, it's their own business, right? If they decide to introduce new mechanisms to show floors and ceilings, they could choose to do that. I don't think that they will. Not because I think that they're bad people. I just think it's tough, and I wrote about this recently in a note that they're trying to amalgamate very bespoke long-term contracts where nothing's really standardized in terms of the duration of the contract, the way the pricing works, when it starts and ends. So they're trying to take all these different factors and kind of jam it into one number. And the way that they do that is by showing the kind of the base escalated price that is being offered, the lowest offered base escalated price in the market. And so as producers and suppliers transition to selling more market-related contracts, obviously that's not being captured in the way that price reporters report the long-term price. So again, I don't necessarily think we're going to see a major change on that front. I think what we'll see is more of producers, whether it's Cameco or others, just talking about it more publicly, maybe on quarterly calls, fireside chats, to kind of let the market and industry know where they're offering and where they're trying to do business.
Yeah, Tim, you've suggested that producers like Cameco should take a harder line in negotiations. What leverage do major producers have today, actually, and how could they reshape the long-term market terms? You mentioned some, but can you expand a bit on that? How can they
Yeah,
benefit from the current market dynamics?
I think the best leverage that incumbent producers or developers have is time. And I think we've kind of seen Cameco do this over the last couple of years where they have the ability to produce, they have the ability to supply utilities with material when they want it. It's just a function of, hey, are we getting the prices that we need? And Cameco has been very redundant and trying to drill this point home to, I think, all stakeholders in the industry and investors, is that the market is coming to them. And it's something that, I've been writing about as well, is that the market is ultimately coming to suppliers, uh, to incumbent producers who will be able to sign higher price contracts in the future, coming to developers who are trying to get mines going. And so that there isn't a rush to have to sign these contracts. This isn't like a technology-based business where it's a winner take all. It is a little bit of a fractured supply side, and that there is going to be a seat for suppliers, whether they're producing 1 million pounds a year or whether they're producing 18 million pounds a year. There's going to be a seat at the table. So I think producers' best thing that they can do is simply wait and say, hey, when you're ready to have the conversation uh, to be supplied uh, th- at the prices and durations we need, we're happy to do that.
Yeah. Let's move. let's move to GNA. I have a lot of questions from my Q&A, sorry, not GNA. I have a lot of questions from my followers and yours, of course. Let's start with Darren. Darren has the first question. Can you give some insights on the recent comments from Namibian Minister of Mines and Energy talking about 51% stakes in new mining projects, and how would that affect uranium developers?
Well, I think anytime the government says they want to come in and take a big stake, it definitely might make people, excuse me, a little bit nervous about that, just in the sense of, a company, it throws off their ability to understand, what the value of the project will ultimately be if a government comes in and takes a larger stake. So ultimately, I think that would be relatively bullish because it might push back development of projects as companies would really want to understand how that would work and how it would impact the economics of the project.
Okay. Tom says that he's curious about the spot market and how it appears to be significantly deeper than anyone anticipated, given the large quantities and small price movements we've seen in the last month. What's your take on this?
I think it goes back a little bit to what I talked about earlier about when the market ran over 100. Given that we're in the low 80s from a structural historical basis, this is still a relatively decently high nominal price. And so I'm not necessarily surprised to see inventories continue to come out of the market. We have junior miners who are sitting on millions of pounds that will be monetized in some way, shape, or form. They can be a seller in the market. Traders are very keen to buy and sell on the way up during these moves. So when we see Sprott Physical raising a really solid amount of capital and buying quite a bit of pounds on the market, these traders are trying to take advantage of that, as they should be. And so they'll be buying and selling all the way up. So there's no doubt that whether you're seeing juniors sell a little bit to monetize some of their holdings, whether you're seeing simple traders take advantage of the volatility, because you got to realize physical traders need volatility. Their lifeblood is volatility. So they're perfectly okay with seeing prices go up and down as they buy and sell, as some of these physical sequestrers are taking pounds out of the market. So I'm not necessarily surprised that there is some depth to this market, in the low mid 80s here. For some reason, years ago, people thought that this market was going to run dry, or you'd hear phrases from investors saying, the spot market's getting thin or it's running dry. I don't really believe in that notion. Whether spot prices are $20 a pound or $200 a pound, there's always going to be material available for sale in this market. The other angle is we don't necessarily know how Sprott goes about buying some of their physical. Are they only buying from willing offers in the market on a day-to-day basis? Are they going around to various relationships they have and say, hey, we're looking for 100 or 200,000 pounds here? Because buying only from willing offers or willing sellers in the market versus going around and saying, hey, I'm willing to buy here at X price because this is where the spot price is right now. Those are kind of different procurement strategies, and only they know kind of what they're doing. So there's that aspect of things as well that I think investors need to consider, because I don't think on a day-to-day basis there's 3, 4, 5, 6, 700,000 pounds on offer. Just based on my experience in the industry, based on my experience in the market, there could be occasionally, but I don't think that's like an everyday sort of thing. So over the past week, for example, we saw Sprott buy about 750,000 pounds in the market. It isn't necessarily clear to me that they're buying from only like firm offers in the market, and that they could be looking to buy pounds from others in and around that, $80, $81, $82 a pound. And part of the reason why they might be doing that as well is, remember, when they raise capital vis-a-vis their ATM, and the spot market is at a certain price, they're really trying to put that capital to work relatively quickly because they don't want to see the market rise or move away from them, because that would be a little bit of a dilutive effect for trust holders. So they have a very tough balancing act, and it's a very difficult job that they have to raise capital and then put it to work at the levels that they raised it at to be kind of as accretive as they can for their trust holders. With all that said, everything that they're doing is tremendously positive for the uranium price, as they are taking out mobile inventories over and over again. And I think some people might get frustrated by the price response. They might say, oh, well, I saw Sprott buy X amount of pounds this week. The market didn't really move. The full effect of that buying hasn't really been felt, because we need to see what happens in the ensuing weeks and months when demand shows up into the market again that might not be a physical sequesterer. With those mobile pounds being removed, it's not necessarily clear what the price reaction will be in the future. So as they continue to take these mobile inventories out, that tightens the market further and further, and there's less available offers in the near term. So we'll see how that affects things in the coming days and weeks.
Yeah, I have a lot of questions lined up here, so try to keep 1 minute answer for the next ones. Here comes the next one. I see a lot of enrichment capacity expansion being announced, but very little conversion capacity expression being announced. Is it possible a deficit of U308 feed can be overcome by lowering tails and laser enrichment, or depleted tails to substitute?
Well, I think that there because of what's going on with Russia, there's a little bit of a supply deficit in the conversion market for the West. I wrote about this a couple months ago in one of my deep dives. I think it was the second one that I did about conversion, where I tried to lay out Western demand versus Western conversion supply. And while there are mild deficits in conversion, I think that's being overcome simply by inventories and secondary sources. So basically, folks looking and buying UF6 on the open market somewhere. And we've seen spot prices top out so far this cycle, call about $90 a kilogram. They're back into this kind of the low 60s or thereabouts. Term prices for conversion are at cycle highs at about $52 a kilogram. And to your point, we have not seen a tremendous amount of primary converters looking to expand supply right now. And I think part of that is historically conversion hasn't been a great business until recently.
Yeah.
It just was not a business that created a tremendous amount of cash flow for these companies. Prices were low. There was always historically a lot of inventories laying around. Obviously, this has changed in the last couple of years, and particularly since the Russian invasion of Ukraine, where we've really seen conversion prices rise dramatically. And so because we're not seeing converters rush to add capacity, it certainly makes you wonder, what do they know that others don't? And I think it's just a function of too many question marks, that they don't want to make these investments in capital expenditures without really having the contracts in hand to know that they're going to generate the cash flow from it in the future. I mean, there's just a lot of questions, right? You have the Springfields in the UK, which is owned by Westinghouse. Obviously, Cameco has a 49% interest in Westinghouse. Do they bring back Springfields? So far, Cameco has publicly said that they don't have the contracts in hand to pursue that option right now. Also, what's going to happen with Russia? Now, we know that H.R. 1042 was passed in the U.S., which means as of January 1st, 2028, there will not be any more Russian imports into the U.S. But what does that look like 5 years down the line, 10 years down the line? These are really long-lived capital asset decisions that these companies need to make, or allocation decisions that they need to make. And they need to know that these are going to be profitable investments 1 year down the line, as well as 5 and 10 years down the line. And so I think there's some hesitancy to make those decisions based on the uncertainty that surrounds the market today.
Yeah. If Timothy can touch upon the scale of big tech hyperscalers as related to the bear base and bull case of increased uranium demand, what's his take?
Yeah, so a lot of the analysts believe that By 2030, we need the U.S. or the world would need to add about 60 gigawatts of capacity for AI. About half of that, call it 30 gigawatts in the U.S. Obviously, that's tremendous. The U.S. runs at about 94, 95 gigawatts of nuclear capacity. I don't think that it's all going to be increased, 30 gigawatts vis-a-vis nuclear, but it seems like nuclear will be able to get a piece of that. And given the context of the supply side, any incremental growth at this point is tremendous for the uranium market. I mean, 5 years ago, 7 years ago, this was a flat market, maybe growing 50 bips, half of 1%. So if this market now grows 1.5% or 2%, that's meaningful based on the limited supply capacities that we have over the next 5 to 10 years.
Definitely. What are the next question? What are Tim's thoughts on new trading firms coming to the market like Mercuria?
Hopefully this increases liquidity. This is a market that's in desperate need of more liquidity. So hopefully, whether it's Mercuria, I know there's been mentions in the news of other banks coming to the industry as well. Ultimately, hopefully this increases liquidity and makes it easier for whether it's traders, whether it's utilities, whether it's sequestrers, whomever might be in the market, to just make it easier to trade. Because what we see in the spot market are these little booms and busts all the time, where the market can move around $3, $5, $7. That just might be a function of liquidity, where there's a lot of demand coming and not a lot of selling, or vice versa. And hopefully these firms introduce a little bit more sophistication and just liquidity to the market that makes the ease of transactions a little bit better moving forward.
Yeah. Next question. Does Timothy have any thoughts he'd like to share on future exit signals and when that time could come?
No idea on the timing. This is why I focus so much time on supply and demand and kind of living in those models every day. Because ultimately prices will continue to go higher until there is enough supply to meet these supply deficits. When that happens, I don't know, but that's why I continue to follow it so closely, is understanding which projects can come online, when they can come online, how much they can come online, and at what price. So, when we look from today through 2040, on relatively conservative demand, we're probably going to see a cumulative supply deficit of somewhere close to 1/3 of a billion pounds. That's just on reactor consumption. That I think is relatively conservative. So that means we're going to need to see a couple 100 million pounds brought to the market over the next 15, 20 years. That's not easy to do when mines are already depleting year after year. So I don't know when that will be, but until the market can bring on that structural supply, I think prices have to go higher.
Okay. Next question. What exactly is CGN mining, and do they have any advantages over Western uranium companies?
Well, they do deals with Chinese utilities. So we've seen some of the deals being announced where they're getting higher base prices and things of that nature versus the Western market. I mean, at the end of the day, that's really just one Chinese entity subsidizing another. But CGN is active, with their JVs in Kazakhstan as well as Husab, which is a mine in Namibia. We'll see if they take on more projects. Like I said earlier, when we talked about China, I would be shocked that they don't take on more stakes in projects or take on more development projects coming up. That's just a function of the Chinese massive appetite for uranium. So I think they will end up doing more. I think they'll have to based on the demand growth that they have ahead. So we'll wait and see which projects they ultimately decide to take more stakes in.
Yeah. If the uranium price is lower in 5 years than today, what could cause that to happen?
That's a great question. I think you'd have to see a major demand event, negative demand event. Based on how we're setting up, it'd be very difficult to see prices lower than where they are in 5 years because we'd see no supply growth. So for that to happen, you need to see something very, very negative on the demand side. you need to see China or the West really walk away or make a major U-turn on the development of nuclear and the role that it plays in the world, which fortunately today that's not the case. But hey, things do happen. There's always a left tail risk, unfortunately, in nuclear because when things go wrong, they tend to go really wrong. But with that said, it would have to be some major demand event. I mean, I just can't imagine a supply side event that could kind of shake this market to the core in a way that would kind of put prices lower 5 years from now than where they are today.
Sure. Here comes the very interesting question. What is Tim's what is Tim's favorite explorer, producer, and developer in uranium space?
Um, that's a tough question to answer. I don't follow explorers too much. I'm not a geologist. I'm aware of the exploration projects that are out there, and watch for just in terms of the news flow and what's going on there. I don't think I really have a favorite developer or miner. I mean, at the end of the day, I look at this market from an investing lens, so it's all about value and upside downside. For years, I always thought that Cameco was a very viable investment for folks looking to get in on the trade. With that said, it's trading at some of the more expensive valuations that we've seen so far this cycle. But there was a lot of folks who kind of shied away from Cameco for many years because they thought that they didn't have like the operational leverage or they weren't running the company well, which I disagreed with wholeheartedly. Now, where Cameco goes from here, we'll kind of wait and see. I think they have a tremendous business. Clearly, they have a lot of economic ore reserves. They have their stake in Westinghouse. They have a conversion business. They can grow the conversion business through Springfields. So they have a very strong business. But what that from, the last 5 years till now, that's easy to look at a price chart and say, yeah, that's great. But I don't know where it goes from here. But, I don't really have, favorite companies or favorite miners or developers per se.
Sure.
I just look at this purely from an investment lens.
Understood. Two more. Actually, one is similar than this one. What is your favorite uranium jurisdiction?
That's a good question. I've never really thought about having a favorite uranium jurisdiction. Um, Look, I think this doesn't really answer your question, I guess, but the supply base is very concentrated, right? I mean, the top 5 uranium jurisdictions account for about 88% of primary supply today. So I think in a lot of ways, the world and the industry needs to think about how do we get more jurisdictions involved in uranium. There's not a tremendous number of them out there, but obviously the United States could grow somewhat. I mean, I model them out to be about 5 to 6 million pounds a year of production by the end of the decade. Could we see more? I think we could if the government were to get involved and help the industry, maybe providing floor prices for their material, things of that nature. But I've written about this as well. Canada is obviously going to be a large swing factor in the market coming up over the next 10 years in terms of their 2 major mines being depleted, some of the big projects that they have in the basin. But in terms of having a favorite jurisdiction, I'm not really sure that I have like a favorite per se or anything along those lines.
Fair enough. Final question. Ryan wants to know your current assessment of Australian law changes and how that could form an oversupply narrative.
That's a good question. I don't think that it would form an oversupply narrative. So there are a couple deposits that could be developed or worked on to come online. Let's just say theoretically, Australia changes the rules overnight. They allow uranium mining in any of their jurisdictions. You could presumably see some deposits come online in the next, call it 4 to 6 years. Again, but because of the time that it takes to bring these deposits on, you're seeing resource depletion elsewhere. So by the time you would bring on some of these deposits, and these wouldn't be gigantic deposits either, we'd be talking, maybe a couple million to several million pounds a year. You're really talking about replacing some of the mines that are in production now. So it would be tough to see that we would have an production narrative if Australia changed some of their laws. So yeah, I don't think that would happen per se in terms of an overproduction narrative simply because they changed some of their laws. Like I just mentioned, this is an industry that's facing a couple 100 million pounds of cumulative deficit from today to 2040. So in some way, shape, or form, these deposits are going to need to be advanced and brought on. It's just a function of whether Australia would decide to change their mind and be more supportive of their uranium mining industry.
Yeah. Timothy, brilliant insights. I didn't expect anything less. I really, really want to thank you for coming to the show. But before I let you go, please, how can investors, people reach out to you?
So they can find me on Substack. It's Golden Rock Research. I try to publish there on a regular basis and just cover various topics of primary research. I focus quite a bit on supply and demand. That really drives a lot of my longer term views in the industry, as well as just commentary and analysis. You know, it, there are times when a lot of things are going on in the market where there's a lot of things to cover. Sometimes there's a little bit less to cover, just in terms of the day to day. But really just try to cover things that really impact both demand and supply, put them in context for my readers, given my experience in the industry. And part of that is there's just a lot of news day to day, especially in the last year about, some of the demand growth, what's going on with AI. So I really try to put a lot of this in context for what's actually going to impact the market and why prices might move around the way that they might.
That was Timothy Cilleri, founder of Golden Rock Research. Timothy, once again, thank you for coming to the show.
Thank you so much.